Hi, it's Nishi. Hope you have a really good day. And in today's video, what I want to talk about is when employee benefits aren't always tax efficient if you own your own business. So I quite often get asked the question, well, I'm thinking of getting this type of insurance or this particular thing, and I'm just wondering whether it's better to put it through my business or if it's more tax efficient if I pay for it personally. So I'm going to cover this from two angles, but and I'm going to also talk about a really good compromise at the end. But in the short video, so let's start with it. Well, firstly, when you're asking the question, is it better if I put this through my business or not, you've just got to really just understand if that benefit you're talking about is really exempt from a lot of taxes anyway. So like a good example of this is like trivial benefits. If you want to give yourself vouchers, well, there's no benefit in kind tax or employee benefit tax on that anyway, so that's absolutely fine to put through your business. There are other things like relevant life cover, key man insurance, various types of insurance which are completely tax-free anyway, which you can put through your business. So what I'm really referring to is other types of benefit that you might be thinking about, like maybe private medical cover, maybe whether or not you want to get your business to pay for your gym membership. And that's the way you do it is quite important because there's a tax difference on whether you put it through your company or whether you pay for it personally. So certain things, when you put them through your business, then what happens is they get treated as if they were paid to you as a salary. So what you end up with is a benefit in kind tax charge, which is partly income tax, but also your business has to then pay something called Class 1A national insurance on it. So income tax at the basic rate is typically 20%, and Class 1A national insurance is, I believe, 14.5% at the moment. So you're really talking about, when you add the two together, this benefit that you've got from your business, the tax on that is going to be about 30, almost 35%. So it's worth just considering that. And then the alternative to not putting something through your business is taking the money out of your business and then paying for it personally. Like if you think about it, when you take money out of your business at the basic rate, you've got your corporation tax bill at 19%, and then you've got basic rate dividend tax, which is about 8.75%, but really for comparison, it's more like 7% when you factor in it's a tax after a tax. So when you are paying corporation tax and dividend tax at the basic rate, really your tax rate is about 26%. So on one hand, you can put something through your business as a benefit in kind and pay employers Class 1A national insurance and the income tax coming out at almost 35%. Or the other side is you take the money out of your business and you pay for it personally, and then your tax rate's around 26%. So there's quite a big difference in the tax rates depending on which one you do. A lot of benefits that you're thinking about, actually you might say, well, it's not worth putting it through my business, then I might as well just take the money out and pay for it personally. And you'd be right to think that. So one other thing to factor in though is quite often a lot of businesses that you're buying from will give you a discount if you put it through your business. So that's when you might not want to pay for it personally, because these higher tax rates you pay will make it worthwhile in terms of the discount that you're getting by having that company policy rather than the personal policy. But maybe a good compromise here is actually get the benefit of putting it through your business and getting that cheaper rate, but then make it good. What does making good mean is you're essentially reimbursing your business for the cost of that benefit. So then actually you never have to pay Class 1A national insurance or income tax on it. What you're actually doing is the business pays for it, you get the discount, and then on top of that, you're then essentially giving the business the money or issuing dividends or salary to cover it, at which point you've benefited from the lower tax rate, but also the discount that you get by putting that benefit through the business. So that's the gist of that. That obviously it's a very complex area, so if you really want to explore it for your own business, then it's definitely worth getting in touch with me, and I'll see you at the next video.